Top 10 stocks not to buy in 2023. Are you ready to take your investment game to the next level in 2023? Then listen up, because we have a list of 10 stocks you should avoid buying. Why? Because these stocks have declining profit margins, patent expirations, and uncertain growth potential. So grab a pen and paper and let's get into the video. We'll show you stocks you need to steer clear of if you want to maximize your investment returns in 2023. Let's dive in. 1. Commodity sector. Investing in the commodity sector as stocks in 2023 may not be the best choice due to various reasons. Firstly, commodity prices are highly volatile and subject to fluctuations in supply and demand, which can impact the profitability of companies in this sector. Secondly, the commodity sector is heavily dependent on global economic conditions, and any recession or economic downturn can lead to a significant decrease in demand for these products, ultimately hurting the stock prices of companies in this sector. Thirdly, the commodity sector is also facing increasing regulatory investigation, with governments around the world implementing measures to reduce carbon emissions and protect the environment. This can lead to higher compliance costs for companies in this sector, which can negatively impact their profitability and stock prices. 2. Real estate. Investing in real estate as stocks in 2023 may not be the best option for several reasons. Firstly, the real estate market is cyclical and can be subject to significant fluctuations in property values, which can impact the profitability of companies in this sector. Additionally, interest rate and government policies ultimately lead to a decrease in demand and hurt the stock prices of companies in this sector. Lastly, the real estate sector is highly competitive, with numerous companies vying for market share. This can lead to lower profit margins, which can impact the stock prices of companies in this sector. 3. Procter & Gamble. Why is it not the best idea to invest in Procter & Gamble in 2023? Here are some reasons. Saturation in the market and increasing competition from new companies may pressure Procter & Gamble's profits. The company has been criticized for being slow to innovate and failing to adapt to changing consumer preferences, which could lead to a loss of market share and hurt the stock price. Its stock fell around 7%. Procter & Gamble relies heavily on traditional retail channels, putting them at a disadvantage compared to e-commerce companies. Failure to adapt to the changing retail landscape could lead to lower sales and hurt the stock price. 4. Chevron. Chevron may not be a good investment in 2023 due to increasing demand for fossil fuels and increasing competition from renewable energy companies. The world is moving towards cleaner and greener sources of energy, and this trend is only going to increase. Renewable energy companies such as Tesla and NextEra Energy are growing at an unprecedented rate. The increasing competition from these companies could put pressure on Chevron's profits and ultimately hurt their stock price. Its share fell 8% this year. Investors should consider these factors before investing in these companies. 5. Eli Lilly. The first reason why we shouldn't buy Eli Lilly as a stock in 2023 is the intense competition they face in the pharmaceutical industry. Companies are investing heavily in research and development to come up with new drugs, which will inevitably eat into Eli Lilly's profits. Its share fell 10%. Many of their blockbuster drugs, such as Cialis and Humalog, have already lost or are about to lose their patients. This will also lead to a significant drop in revenue for Eli Lilly, as they will have to compete with cheaper generics. Eli Lilly has been investing heavily in R&D over the past few years, and while this may pay off in the future, it may also lead to a reduction in profits in the short term. 6. Honeywell International, HON. Honeywell International, a multinational conglomerate, may not be the best stock to invest in for 2023. Firstly, the company's revenue has been declining in recent years, 10.8% in the first quarter. Secondly, they have high exposure to the aerospace industry, which has been hit hard by the pandemic. Honeywell faces stiff competition from other companies in their industry, which could impact their market share and ultimately their stock price. These factors, combined with the current market conditions, make it risky to invest in Honeywell International as a stock in 2023. 7. Johnson & Johnson. The first reason why we shouldn't buy Johnson & Johnson as a stock in 2023 is the legal issues the company is facing. These issues range from the company's role in the opioid epidemic to the talc lawsuits. These legal issues are leading to a decrease in stock prices. Its stock price declined 12.3% over a 3-month stretch. Another reason is the company's history of product recalls. Johnson & Johnson has had several high-profile product recalls in recent years, including the recall of the popular pain reliever Tylenol. The third reason is the intense competition they face in the pharmaceutical industry. Companies such as Pfizer and Merck are investing heavily in research and development, which can lead to innovative products that Johnson & Johnson may struggle to keep up with. 8. Pfizer. Pfizer is a well-known pharmaceutical company that has been in the news a lot lately thanks to the COVID-19 pandemic. But even with the success of their vaccine, we believe that investing in Pfizer in 2023 may not be the best idea. While the company's revenue has increased over the past year, their profit margins have been declining. This could be due to increased competition or rising production costs. Another factor to consider is the expiration of Pfizer's COVID-19 vaccine patent. With the patent set to expire in 2023, Pfizer could face increased competition from generic brands, which could affect their revenue and profit margins. Its shares tumbled 15% in 2023 beginning. While the company's stock has been performing well over the past year, there are concerns about the company's future growth potential, given the factors we just discussed. 9. Devon Energy. Devon Energy Corp is one of the largest oil and gas producers in the United States, but that doesn't mean it's a smart investment for 2023. The first reason why we shouldn't buy Devon Energy Corp as a stock in 2023 is the declining demand for fossil fuels. The world is moving towards cleaner and greener sources of energy, and this trend is only going to increase. Devon Energy may find it challenging to keep up with this trend, and the company could face declining profits as a result. In the first quarter, its 17.7 share fell. The second reason is the increasing pressure from governments and consumers to reduce carbon emissions and protect the environment. The oil and gas industry is known for its volatility, with prices fluctuating dramatically based on global supply and demand. This volatility can make it difficult to predict the future of Devon Energy Corp's stock price. 10. Halliburton. Why it might not be a good idea to invest in Halliburton in 2023. The company has a high level of debt, which may limit its ability to invest in new technologies and research to remain competitive in the market. The industry is highly volatile and unpredictable, with fluctuating oil prices and global geopolitical tensions that can significantly impact the company's stock prices. Its share fell 19.6% in the first 3 months. Halliburton's performance is impacted by external factors such as the 6% decrease in West Texas Intermediate crude prices during Q1, which is beyond the company's control. Additionally, the stock had a significant increase of 55% in Q4, making it susceptible to profit-taking as the new year began. And that concludes our list of the 10 stocks you should avoid buying in 2023. What do you think about this list? Are there any stocks that you were surprised to see on it? Must share your thoughts in the comments section. Stay tuned for the next video. Until then, take care.